Are you tired of watching your savings gather dust in a low-interest bank account? What if I told you there's a way to make your money work harder for you? Imagine waking up one day to find your investment has doubled overnight. Sounds too good to be true? Well, it's not if you know how to invest in stocks the right way. Did you know that the average annual return of the stock market is about 10%? That's way more than what your savings account offers. But here is the catch: investing in stocks can be risky if you don't know what you are doing. So, how can you minimize that risk and maximize your returns? Buckle up, because I'm about to reveal the most risk-free way for beginners to start their stock market journey. Trust me, by the end of this video, you'll be itching to make your first investment. Have you ever wondered why some people seem to effortlessly grow their wealth while others struggle to make ends meet? The secret might be simpler than you think. Are you ready to take control of your financial future? Because after watching this video, you'll have the knowledge and confidence to do just that. What if I told you that you could start investing in stocks with as little as 500? Yes, you heard that right, just $5. Curious about how the rich keep getting richer? Well, they're not keeping their money under their mattresses, that's for sure. Now, let's dive into why investing in stocks is not just a smart move, but a necessary one for anyone looking to build long-term wealth. In today's world, where inflation is constantly eroding the value of our money, simply saving isn't enough. Investing in stocks offers you the opportunity to outpace inflation and grow your wealth over time. But here's the kicker: it's not just about investing in stocks, it's about investing intelligently and with the least risk possible. This is especially crucial for beginners who might be intimidated by the stock market's volatility. The good news is, there are strategies that can help you minimize risk while still reaping the benefits of stock market growth. So, what are these accessible ways for beginners to start investing in stocks with minimal risk? Let's break it down. First up, we have index funds. These are like a basket of stocks that represent a specific market index, such as the SP 500. By investing in an index fund, you're essentially buying a small piece of hundreds of different companies. This diversification spreads your risk and reduces the impact of any single company's poor performance on your overall investment. The beauty of index funds is their simplicity and low cost. You don't need to be a stock market guru to invest in them, and they typically have lower fees compared to actively managed funds. Plus, over the long term, index funds have consistently outperformed most actively managed funds. It's a win-win situation for beginners. Another great option for beginners is exchange-traded funds, ETFs. These are similar to index funds but trade like individual stocks. ETFs offer the diversification benefits of mutual funds with the flexibility of stocks. You can buy and sell them throughout the trading day, and they often have lower expense ratios than traditional mutual funds. ETFs come in all shapes and sizes, focusing on different sectors, regions, or investment strategies. This allows you to tailor your investment to your interests or beliefs. For example, if you believe in the future of renewable energy, you could invest in an ETF that focuses on clean energy companies. For those who want a completely hands-off approach, robo-advisors are a game changer. These are digital platforms that use algorithms to create and manage a diversified portfolio based on your risk tolerance and financial goals. You simply answer a few questions about your investment objectives, and the robo-advisor does the rest. The benefits of robo-advisors are numerous. They offer professional-grade portfolio management at a fraction of the cost of traditional financial advisors. They also handle rebalancing and tax loss harvesting automatically, ensuring your portfolio stays optimized without you lifting a finger. Now, let's talk about dollar cost averaging. This isn't a type of investment, but rather a strategy that can be applied to any of the methods we've discussed. The idea is simple. Instead of investing a large sum all at once, you invest smaller amounts regularly over time. This approach has several benefits. It reduces the impact of market volatility on your investment, as you're buying at different price points over time. It also takes the emotion out of investing, as you're not trying to time the market. Plus, it's a great way to build the habit of regular investing, which is crucial for long-term wealth building. But here's the thing: while these methods can significantly reduce your risk, it's important to understand that no investment is entirely risk-free. The stock market will always have its ups and downs. However, historically, It has always trended upwards over the long term. Now, let's address the elephant in the room: what happens if you invest in stocks incorrectly? The consequences can be severe and far-reaching. Many beginners make the mistake of trying to time the market, buying when they think stocks are low and selling when they think they're high. This strategy rarely works and often leads to significant losses. Another common mistake is putting all your eggs in one basket. Investing all your money in a single stock or sector leaves you vulnerable to major losses if that particular company or industry faces challenges. This is why diversification is so crucial. Emotional investing is another pitfall to avoid. Making investment decisions based on fear or greed rather than rational analysis can lead to poor choices. Panic selling during market downturns or buying into overhyped stocks without proper research are classic examples of emotional investing gone wrong. Lastly, neglecting to do proper research or blindly following hot tips can be disastrous. The stock market is not a get-rich-quick scheme. Successful investing requires patience, discipline, and a willingness to learn. So, what's the takeaway from all this? Investing in stocks can be an incredibly powerful tool for building wealth, but it needs to be done right. By starting with low-risk options like index funds or ETFs, using strategies like dollar-cost averaging, and avoiding common pitfalls, even beginners can successfully navigate the stock market. Remember, the key is to start small, stay diversified, and think long-term. Don't let fear hold you back from investing, but also don't let greed push you into unnecessary risks. With the right approach, anyone can harness the power of the stock market to achieve their financial goals. In conclusion, the most risk-free way for beginners to invest in stocks is to start with broadly diversified, low-cost index funds or ETFs, implement a dollar-cost averaging strategy, and stay committed to your investment plan for the long haul. It's not about getting rich overnight, but about building sustainable wealth over time. So, are you ready to take that first step towards financial freedom? Remember, every expert was once a beginner. The sooner you start, the more time your money has to grow. Don't let another day go by watching your savings stagnate. Take action now, and future you will thank you for it. Happy investing.